representation, or OML ASX, please enjoy this case study and we'll get stuck right in. So please pause the video. This is a disclaimer on forward-looking statements. Basically, in summary, the presentation and the information is not a recommendation or solicitation to buy or sell any securities. It's for information and educational purposes only. Again, with investment processes, risk and limitations, please pause the video. Under CFA Standard 5B, with investment analysis, recommendations and actions, communication with clients and prospective clients, we're going to highlight these risks. So again, results may depart, systemic volatility, large institutions in and out of holdings can affect price volatility. So oOh Media Limited, or the company, is one of Australia's largest or leading out-of-home media companies. Operates an extensive 35,000 digital and static assets. These include like roadsides, retail centres, airports, train stations, bus stops and office towers. The company controlling around 42% of the out-of-home market share in Australia and New Zealand. The company is also a founding member of peak industry body OMA, or Outdoor Media Association, with other leading names such as Val Morgan, Bishop and JCD or JCD to go. Purpose is making brands unmissable. So, oOh Media overview, what is it? Out-of-home media is any form of visual media found outside of home. Obviously, as I said before, forms can include ads, indoor, outdoor signs, street furniture, including bus stops or benches, etc. Place-based media includes like cinemas or at stadiums. Remember when you drive past that same billboard onto work, or you catch a train, you see that billboard every day? That's out-of-home media. So the numbers don't lie. Investment recap. Initiation of coverage began around July 2023, acquired shares in August. Following that, around 30% or greater than 30% returns in 6.5 months, not including dividends, and 52-week high in 52-week highs in 6.5 months. What came to pass? So we have a screen clipping from a previous presentation, one I actually made in my analysis in 2023. We estimate on the low case that a lower weighted average cost of capital, but poorer operational performance, leaving us with $1.67 intrinsic value per share. OML ASX has surpassed our low case price. We assumed at the time it would continue. So as we saw in that screen clipping of the chart there, it had 52-week highs, about $1.80 something, surpassed that low case. We thought it continued. What could be done? But as we see on the chart, hit those 52-week highs, but then we see lower lows and a downtrend. So that then went down and then recuperated, and then we closed our position at those same 52-week highs. So what we could have done better is just locked in those profits once it had surpassed that low case. Now the numbers don't lie. The returns, as we see, we got a return of 48.12% as provided by Totality. So you can see that's a screen clipping from the broker, and please read and review. Now, oOh Media Limited investment performance versus the benchmark, or ASX 200. So year to date, our OML ASX investment produced a return of 48.12% versus the index ASX 200 had a return on investment of only 6.87%. So adjusted for annual inflation, the investment return is equivalent to 44.32% versus the investment return in the benchmark is equivalent to 3.07%. Risk management. The Citino ratio is a risk-adjusted performance measure that evaluates an investment return relative to its downside risk or potential for losses. As we see our portfolio Citino ratio, so for the overall portfolio, year to date was 1.7. So it's different to Sharpe ratio. It doesn't penalize all volatility. It just penalizes the downside deviation or downside volatility. So holdings resilience despite negative sentiment. So as we saw in that chart before, we saw those lower lows in that downtrend. So why did I continue to hold even despite lower lows, news articles, price revaluations and downgrades from the institutions? So we look into out-of-home by itself. Out-of-home has stood the test of time. Early forms of out-of-home predate to ancient Romans, to emerging from ancient Egypt as early as paintings on caves. Physical real estate matters, i.e. billboards, online advertising, outputs have large barriers to entry. Online advertisers compete against other competitors. They're bidding for key search words, to get on popular websites, banners, and they're paying way more cost per lead. And then they're also competing against ad block services, a net double negative for online forms of advertising. So ways to avoid out of home: removing one's eyes, an uninhabited place away from civilization, or if you stay at home all day and allow someone to run errands for you. So the effectiveness: out of home provides a more effective form of advertising. According to the Outdoor Media Association, out of home drives more online activity per ad dollar spent than any other media. 382% more effective than TV, 200% more effective than print, 63% more effective than radio while customers are driving. Out of home reaches more people than any other advertising channel. 93% of the Australian population living in and around capital cities. So, is out of home achieving its max potential? While it is materially outperforming its competitors in respect to return on invested capital, enterprise value to operating profit, operating margins, and operating profit growth, among other various factors, in which we expand at a company level, we do see underperformance. So the underlying evidence of OML's operational share price underperformance includes institutions' hyperfixation on half-yearly earnings and full-year earnings, blindness to their longer-term value creation. So the material underperformance in its earnings per share is greatly affecting its valuation, which in turn affects price targets and PE values. Large institutions such as Australian Retirement Trust and Perpetual existing or ceasing to be substantial shareholders due to short-term technical factors as de-risking to reduce overall portfolio exposure in certain sectors. This and such announcements could colour the market's perception of oOh media. So the competitive landscape. We look at the market share from calendar year 22 to 24 of competitors, players in the out-of-home space and digital out-of-home space. We see out-of-home snatching up more of that market share compared to others and JCD. Valuation, investment thesis. It's a high-quality business with year-long runway for revenue and earnings growth. Attractive business model, double-digit operating income growth and a growth outlook or positive outlook. A high rate of operating income growth should drive significant margin expansion. We do see though the capital structure and capital allocation is not yet optimized. OML has a significant scale advantage and opportunity in the Australian and New Zealand region. So we look at its biggest competitor, following behind at 27% market share, JCD. So we see it outperforms in revenue. Its EBIT, as from the 2021 figure, the market share, obviously, as we just alluded to earlier, has more employees and has larger or more large format digital and static sites. So just billboards, they have more. We do see underperformance in the average revenue employee. For OML, it's 792,000 or around that versus JCD's, which is around 809,000. So we do want to see that kind of increased. So intrinsic valuation price for OML represents a significant discount to JCD, even though OML is a vastly superior company in the Australian and New Zealand market. So it's, as we said, undisputed market leader, more presence in the out-of-home, large brand, IP and high intangible assets, scales 1.5 times revenue. Its EBIT compounded annual growth for 2026 to 2028 estimated is greater than 12%. OML becomes the obvious choice for companies wanting to get the max reach for their out-of-home advertising. So solution. So we have a couple or proposed list of recommendations to management to further unlock shareholder value. One is the DRP, so reinvest all dividends into business operations and the business itself. While it is nice to receive cash dividends as an investor, when a company is materially underperforming its max potential, it should keep reinvesting to allow for share price appreciation. Reintroduce the DRP plans or dividend reinvestment plans, while also conducting heavier buybacks by insiders. I tried an approach. One, DRP to increase shareholders' own holdings. Two, buybacks to avoid the dilution of those holdings. And three, increasing insiders tied to share price incentive. This leads us to our next recommendation, recommendation 2. Management incentive and linkages to share price performance. Increase and tie management incentives and KPIs to share price performance. Incentives drive all human behavior, as Bill Ackman quoted. When insiders conduct large buyback programs, this shows confidence in their ability to create shareholder value. Incentives explicitly tied to share price performance, ensuring management returns are aligned with shareholders. That is all for today. Thank you very much for tuning in and watching this video. I hope you enjoyed it. Any feedback, please leave a comment, like, subscribe. and happy to put more out there and get some more videos. So please stay tuned. Thank you very much.